Hello, I'm Toycat, and yesterday the United States made their biggest interest rate rise in 22 years. This is something they did, if you haven't heard, to toughen their fight against fast rising prices. And that makes perfect sense if you just read the headline and you don't really understand interest rates. You can just read it and go, wow, they're doing something about that? That's so good. Except if you think about it, it's much more confusing because their plan is to fight US inflation, which is at 40-year highs right now, and is causing spiking costs being felt by households around the world. There is a cost of living crisis because things cost too much, and so the central bank's plan is to raise the prices for people, businesses, and governments to borrow. That's right, to fight high prices that are going up too fast. They're going to raise prices. And wait, that doesn't sound like fighting at all. Except it's not just the United States doing this. The Bank of England, which is the UK bank, the Bank of England is doing it. It's not just the Bank of England either. In fact, most central banks around the world, if you look at this direction arrow right here, are increasing their central rates right now, making it more expensive to borrow money and therefore indirectly and directly increasing the cost for households in most of the world, besides China, Denmark, Europe, the Eurobank as a whole, that is, Indonesia, India, Japan, Russia, Switzerland, and Turkey. And, for the vast majority of those, the reason they're going down is political, not economical based. Should we talk about Turkey with their 60% inflation at some point? I think we should at some point in this video. But yeah, this is going to be a video talking about how the weird fact that inflation is at a massive high and wages are not growing to equally match it is somehow a thing that we are fighting by making things more expensive for everyone. And actually, that is good economics. This actually is a good decision to a lot of people, maybe not to everyone, and let's explain how that makes any sense whatsoever, because it is very strange. And honestly, raising interest rates is something that you probably haven't heard in maybe 22 years. That's a lot of people's lifetimes, right? And the reason for that is we've had very historically low rates. This is the United Kingdom, but it's broadly indicative of rates around the world. As you can see, rates used to hover somewhere around 10% for most of the interest rates history. Maybe 5% would be a more long-term normal, but post-2008, there was a fun thing that happened. We've kept interest rates low, and every time we tried to raise them, things would go questionably, so we just left interest rates low for a really long time. So most people have lived in a world of super, super low interest rates, and it's been perfectly fine, except, do you remember, look at this graph right here. Things have been perfectly fine for most of that time. Everything's perfectly great here. We even had a risk of deflation somehow, despite super low interest rates. But now, something of that happened in the last 2 years, maybe a big shutdown of the world economy. We treat it like it was a tap that could be turned off for the benefit of health, is now starting to cause us issues. Who would have expected? This is crazy, mind-blowing stuff. But no, more seriously, let's talk about how this actually happens, because it is very weird that in a world of wages going up slower than inflation, we are trying to increase costs for people. But let's explain it, and here is the graph that does it all. Honestly, we don't need the rest of this video. If you understand this graph, everything's wonderful. Interest rates set by these central banks, because what even is an interest rate, right? Like, surely I don't borrow money from the United States government, so it's not a big deal to me if they raise the interest rate. I don't borrow money from the Bank of England, so what do I care what their what their thing is? Honestly, you don't have to care, except the reason that you do have to care is the money market interest rates are set based on this. Even though you don't borrow from the Bank of England or the Federal Reserve, the financial institution that you borrow from probably borrows from someone that directly borrows from there, or they directly borrow themselves. There is, as a result, because any money they need to panic up from thin air. By the way, central banks haven't existed full of history. There's a really interesting story as to how they came to be, but just trust for now that there is a bank that can print money, so whenever someone needs money, they can lend it to them no matter what. They're called a lender of last resort. If a bank desperately needs money, or they have a ton of money they're holding on to that they want to make some interest on, they deposit it with the Central Reserve Bank, or they get it printed by or just borrow it from the same Federal Reserve Central Bank. It's not always printed. They usually have a lot of cash stock on hands too, for what it's worth. It's just recently we'd talk more about printing, just for the sake of, so you understand this. So with that said, now it's important to go back to this graph and say that, like, okay, the money market borrows from them, and then the expectations are set from that, and so then the bank rates, the asset prices, the money credit, the exchange rate, are all based on those things, because obviously people want to buy currencies where the interest rate is high, and they don't want to buy currencies where the interest rate is low as much, so your exchange rate varies. All of those things together are going to affect the supply and demand in goods and labor markets, which changes wage and price setting. Domestic prices go down. Okay, you get the point. This is a very complex graph. It's set up by the European Central Bank, and it's simple enough, but we'll have to come back to this way later. Let's take things back to a much simpler thing, which is this: when interest rates go up, prices for any borrowing you do goes up too. This means that mortgages, as a great example, go up. And it's weird because, again, a mortgage is already higher than 1% or whatever the rate is, but mortgages are not just you borrowing straight from the central bank, they're you getting all these weird services and getting a house outfit. So mortgage rate interest rates have gone up. I don't think we can prove this on this page, but mortgage rate interest rates have gone up in the UK. 2.26 is now the norm. It was 2% just a year ago when I looked. Oh, less than 2% in most cases. And as a whole, it seems as though mortgage interest rates are going up, but also so too are saving rates. So here is how this really works. By increasing, and by the way, I'd say the biggest... The reason this is the one people talk about the most is because the biggest single expense most people have is their housing, and the cost to finance that house has just gone up substantially, which has all sorts of effects later down the line, but it mostly just means that households now have significantly less money to spend. The difference between 2.26% and, let's say, interest rates go up by 0.25% tomorrow, we have to scroll down here. The difference between just a 0.25% difference is a mortgage going from £2,411. This is a very expensive mortgage. I shouldn't have used real numbers. But you can see that a mortgage would go up £70, leaving you, some percentage with less money at the end of the month. If you were borrowing a lot of money, like most people do for their houses, if you were someone who had some amount of money laying around, or you could get some money to save, however, your interest rate on that will go up substantially too. It's worth mentioning, basically every interest rate will go up as a result, from credit card debt to, your car loans to, what do people borrow money for besides, houses and day-to-day living expenses. I feel like it's both extremes there. Anyway, with that said, everything goes up in price, all sorts of borrowing, and the effect that this has, as this wonderful little graph from Economics Help explains, is the increased cost of borrowing means that it's going to be harder to invest. A house is one type of investment. I think it's one of the best you can make. I know the last video said don't buy a second house, but a first house, very smart investment. You should try to do it if you can at some point. I know that's a very simplified thing, but leave that to the side for now. So buying a house is a good investment, but let's just say not just houses. Let's say you want to start a business. Now the interest rate on your business loan has gone up substantially, which means the bank decreases or increases the odds of you making it, which means that there is less investment. You can't make your fun, let's say you want to make a half bank, half bakery, a bankery. You can't make that investment because the bank's like, at 3%, a business loan, I bet you could have made that payment. 3.25%, nah, the bankery's a dumb idea, and you should go home, toy cat, and start making videos about interest rates instead. So, reduced investment, no bankery on my street anymore, lower economic growth, because now, if someone's like, I wanna go to a bank that gets me, that can give me a pastry. Instead of giving me interest, £1.50 a month, make me a nice pastry. So now there's low economic growth because they can't put their money in and they can't buy the pastry. And now I'm not supplying goods for my people, etc. Everything's great. So obviously that's their investment angle. But I wasn't gonna start a bankery. I want to start a bankery, but I'm not going to regardless. But I am going to be paying higher mortgage interest payments. This means that every extra pound that I can't pay because I'm paying off my mortgage, I can't spend at local goods and services like bankeries. Now, like the local Olive Garden, there's going to be less consumption going on, which is just spending money just immediately. And so now there's lower economic growth. Also, though, there's a return to saving, because like we mentioned, the price, getting 1.3% back for your savings. It's been so long since I've seen an interest rate for a savings account that didn't start with a zero. Genuinely, I in my entire lifetime, I don't think I've ever gotten more than 0.5% or something. You can get 1% interest. You put £1,000 in, you'll have £1,010 next year. That's how crazy we're going in this rate. So now more people are actually going to say, what if we put our money just in a bank account, just in a box that slowly grows money later? So that reduces your consumption, because for every £1,000 you put in a box, you can't buy pastries at my lovely bankery. But then also, as well as that, higher mortgage interest payments means that fewer people can buy houses, because most people don't care about the price for house. Like, what is £600,000 over 28 years? It doesn't mean anything to anyone, but $2,411 a month, that's unaffordable. I could have afforded $2,372 a month, but not this amount, or you get the point. These are all incredibly expensive mortgage products. Should have used a better example. I think just to make this fairer, let's go look at this house right here. I always talk about London-based houses, which are incredibly expensive compared to the country. So this is a house in Liverpool that costs £10,000. And this £10,000 house, the mortgage on it, if we go down to the calculator, would be £42 a month. Okay, I'm not gonna. You know, that if you have a mortgage of £42, I'm genuinely jealous of you. So their interest rate goes up by 1%, let's say. Now they've got they've got £5 less a month they can spend. That's like, I don't know. That's 10 spicy chicken wings at KFC you're not buying. And so prices go up for everyone, right? And so, man, I could do with some spicy wings. Do you think KFC's open this time of night? Anyway, so as you can see, falling house prices because fewer people can afford the massive payments on houses like this. And as a result, also, the hot money flow, I don't even know what this is meant to say. Basically, money flows in because people want to save money in your economy versus theirs. So your exchange rate changes, inflation goes down, everything, bada boom, bada bing. And if you want proof as to how that this doesn't work, let's take a look at inflation in Turkey. So the ruling party in Turkey, or let's not say it's a political decision, but it's a political decision, has tried to keep interest rates low. And by low, I mean like they've got the highest on this list, if I'm not mistaken. Yeah, 14%. Turkey and Russia are both at 14% interest, trying to decrease them. They were at 17 and 15% before, but they're trying to decrease their interest rates to make things more affordable. Like mortgages will go down in price, business lending will go down in price, which will increase economic growth. But because there's more and more money floating around, inflation goes up. I feel as though we didn't explain inflation very well here. Inflation is basically just that if me and you have £1 and I don't know, an apple costs £1, then okay, there's 2 apples, we both buy 1 each. And the economy works just like that, because there's 3 people in this economy and 2 apples, apparently. But now we both have £100. I can't buy 100 apples because there aren't 100 apples there. So the seller is going to say, I'm going to charge £100 for this apple, or £50 for this apple. But then the other person, who also has £100, now tries to buy one, and then the price ends up at £100. And even though we both have 100 times more money, we don't really, because the amount of goods hasn't increased to match that. Inflation is when you have economic growth, you have more money floating around, but not more goods to match it. Why don't we have more goods to match it? Didn't something happen in the last couple of years? Did we shut off the world economy and shut down factories and production plants everywhere? I don't think we did that. Let's hypothetically say though that we did. Let's see what's happening now. Is anything fun? Oh, this isn't fun. Let's go to business. Is it the high street isn't dead? Says Sports Direct boss. Yeah, high street isn't dead. Says the high street. Sorry. Okay, staying on point here. We're gonna do this. So the interest rate. The inflation rate has gone up because not only have we done the one side of things where there's fewer goods being produced, but we gave everyone a ton of money. We printed a whole bunch more money than we ever have before, and now there's a ton more money floating around and fewer goods, and so boom, now is inflation going up? I think it is. Here's a fun chart showing inflation and interest. Every time inflation goes high, we usually try to match it with interest rates. In a few cases, we kind of predict one way before the other, but you can see that we try to keep interest rates roughly, we try to raise interest rate when inflation gets too high. When inflation is 30%, it's far too high. And that's why things used to cost way less back then than they do now, because we had crazy inflation then. And you know what? This video, to keep it in point before we go, it's just to say that all of those things are the desirable outcome. We want to lower inflation, and sadly, while lowering inflation, we're going to lower economic growth. The reason that we were okay with having such low interest rates for so long is because it encouraged investments in all sorts of things that probably wouldn't make sense in the normal market. But when you're borrowing it, in the case of genuinely even right now in Switzerland, Denmark, or Japan, when you're borrowing at negative rates, when they're saying, here is £100 now, pay us back 99 quid in a year, or £99.25. Like they are, obviously the end consumer rarely actually gets that. But the fact that there is just this interest in give money out as much as you can, grow that economy, and it worked for the most part, and again, until it didn't, because something happened in the last year. And so yeah, now we're starting to raise rates because we have to actually work like a real economy at the end. Hopefully, we get back to the world of super low interest rates and anyone can do anything. You can start your bankery, you can start your... Okay, hear me out here. I got a business idea. What if it was fast food, but it was loot boxes? So you paid... £5, instead of getting 10 chicken wings, you might get a large fries on the low end, just some chips and a drink. Oh no, you gotta roll again. Or you might get like a a Wagyu steak and, you know, tender stem. You might get like, you might get like some really high-end stuff, and you don't know what you're getting till the end. We add gambling mechanics to food. Boom, someone will give me money if they're getting paid to give me money. But if they actually care about their money, because there's a finite amount of it, and they, you know, they're getting charged money by the central bank for borrowing it, maybe they would give less of it. And so we'll have less economic growth because now you can't buy money. I think that's a good idea, by the way. And so yeah, did this video make any sense? I hope it did. And now we can come back to this and explain how, yes, the official interest rate is set by the government. However, even before it's set, there are expectations of what it's going to be, which are baked into the money market interest rates, which means that bank rates, as well as asset price, bank rates go up. When bank rates go up, this means that asset prices generally go down because you can't borrow to buy them. This money and credit gets scarcer, and so all of this stuff makes sense, I hope. Was this a good economics video? Let me know. I find personal finance to be very interesting, and a part of that is the whole weird world of how increasing prices for people genuinely is a good economic solution to prices being high. It just really sucks for everyone, which is a good way to describe the current economy, right? Like, it really sucks for everyone. And if you enjoyed this video and you thought it wouldn't suck for someone else, then, I don't know, say something nice in the comments. I appreciate nice comments on these. And, I don't know, buy my merch. It's not available yet, but, like, go look in the description where it says merch, not available now. And I do a bad job at promoting myself. Hope you all enjoyed. I'm gonna go watch the last episode in the season of Ozark, and I'll see you next time. Goodbye. Wait, yeah, subscribe. There we go. That's promotion. I know how to run a YouTube channel over here. Yeah, subscribe. Even maybe turn on those notifications, huh? Wouldn't you love to be notified of the next video where I talk about US inflation rates? Ooh, talk dirty to me. Okay, goodbye.